Hey everybody, welcome to today's video. Today we're going to be talking about the big question, the question on everybody's mind. What is the interest rate? I can tell you in the last 20 years or so, I've been asked that question probably 17, 18 million times, it feels like. And while I fully understand the question, it goes with some explanation, and that's what we're here to do today. So buckle up. This one's going to be action-packed. I've got so much information to cover here. It's a simple topic, interest rates, but I felt like this one deserved a video, and so I decided to make this one today because we're in a little bit of an interesting time as far as interest rates go themselves. And so I'm going to try to really kind of break things down for you, and I'm going to go as fast as I possibly can. I know I respect your time, but hang with me because we do have so much to cover here. And in today's video, we're going to do a couple things. We're going to go through a high-level discussion. I'm going to try to break things down. I'm going to tell you like how rates are determined, where they come from, how do lenders come up with these rates, what goes into figuring out an interest rate. We're also going to talk about is the lowest rate always best? So I kind of want you to think about that for a minute as we go into this. We're going to talk about that when we get there. But a lot of people think that the lowest interest rate is the absolute thing that they're going for. And I will say in many cases it is, but you may find that some cases it's not. So we'll talk about that. I'm going to give you my prediction for 2024. That one you want to stick around for as well. May or may not be what you think. And some pro tips as we always do. And I think these tips will be very helpful to you if you're somebody that's looking to get active or as somebody that's already active as an investor in real estate. So here's where I wanted to start things. And let's just think of things from a lender's perspective. So from a lender's perspective, probably the most benign example I can use is a home loan. So you're going out to buy a home that you're going to live in, a residential home. And you can go on the internet, you can see these various ads that they say, hey, the 30-year fixed rate on a mortgage is, say, 6% or 5.5% or whatever the daily rate is at the time. And I see these ads sometimes and I think to myself, it's a little bit misleading, I think, because yes, that rate might be available. It's probably not available for everybody that's going to go and apply. What I mean by that is that rate that they're talking about might be for somebody that has an 800 credit score, has an amazing job, has a 25% down payment to make, the house is in an amazing location, and they're going to use a 30-year loan, and that's how they come up with that rate. But again, right there, not everybody comes in with that same picture. So not everybody may be given that same rate. So again, that's where kind of this starts. And I just wanted to start it there. Then you get into investment and commercial lending. And then you talk about things like asset type, amount of down payment, experience, net worth, liquidity, loan amount, repayment terms, prepayment penalty, full recourse versus non-recourse. You got things like buy downs, location by population, lender appetites, debt coverage ratios, the index that's going to be used, which lender you select, and then within that lender, which program you might use, and on and on and on. And don't worry about if you don't know what all those things mean. They're kind of irrelevant for this discussion. I just wanted to point out here that there are so many factors that go into an interest rate. And you can't know that rate when you're talking to somebody on the phone. Somebody like me can't tell you an interest rate on something until we really go all the way down the path. And that's how you kind of weave through all of these different things and get to an interest rate ultimately. But it starts here. And so the best way I could think of to break all of this down is to talk about what I call buckets. And the buckets are really just kind of a jumping off point for us where we start the conversation with you. We talk about, okay, what are we doing? What are you looking to purchase or what are you looking to refinance? And so these various buckets are where we begin. So you've got 1 to 4 units. That's anything from a single family, duplex, triplex, or a fourplex. You've got 5+ units, which we consider multifamily. And again, that's a whole different bucket from the 1 to 4 units. Small balance commercial, that's under $1 million for the loan amount. And then commercial over $1 million. Anything over $1 million is going to fall into a whole other bucket. And then you've got owner occupied, and that's typically meaning the business is occupied or the business is owned by the company or the asset that's or the entity that's going to be purchasing the real estate, owner occupied real estate. And then you've got something I call specialty, and so we'll go into all of these. So in the 1 to 4 unit bucket, you've got a couple different ways this can go. You've got fix and flip, which would require a short-term loan, and that might include the rehab to do the fixing and fixing it up. Those rates right now are running anywhere between 9 to 12%. By the way, just a disclaimer here on these rates that I'm going to talk about. None of these rates are meant to be a quote. As you're going to see, there's no way I could even quote you if I wanted to, but these are just for educational purposes only. These are very, very broad range rates, but I meant them to be as close as I possibly could get to what's really going on in the marketplace. So just to give you an idea of where things are likely to fall in the event that you're going out to get some of this financing. But as you're going to see, and as we were talking about, many, many things will affect that interest rate at the end of the day. So it could be less, it could be higher. I can't promise anything here. I just wanted to give you kind of an idea, a really probably a rough idea, but at least an idea of where things that we're seeing in our business play out on a daily basis. Then you have buy and hold, long-term financing. And those rates are for a short-term rental. So you have an Airbnb property, those rates are falling anywhere between 6 and 8%. And then you've got long-term rentals, which would be like a 12-month lease. Those rates are also probably around the 6 to 8% range currently. Now you've got 5 units or more, which is multifamily. Now we're into a different bucket of lending. And when I'm talking about buckets, I'm really talking about lending buckets. And this is where we go. So now we're going to a different set or subset of lenders. And again, within the 5 unit realm, you have things called value add loans or value add lenders. They're typically short term. There are some that we have done in the past that are long term. And those longer term value add loans can have rates down as low as 6%. More on the shorter term, you're going to be on the higher range, closer to 12, again, maybe 9 to 12% in that interest rate range. Long term under $1 million, which is also known as small balance, those rates are roughly in the 7 to 9% range. And then you've got long term over $1 million, where you have things like agency, which would be Fannie and Freddie. You've got HUD, which is also known as FHA. There's other options there too. And those rates can range anywhere from 5 to 7%. They were lower than that historically up until last year. We're hoping that obviously they go back down, but that's about where they are right now. And now you have basic commercial. Commercial comes with also value add loans. So those are shorter term loans, and those range anywhere from 7 to 12%. You've got long term under $1 million. Again, that's called small balance commercial. Rates are typically a little bit higher on the small balance than they are for anything over $1 million. I put 7 to 9%. Again, rough range there. Long term over $1 million, we use things like life insurance companies, CMBS lenders. And again, don't worry if you don't know everything about those types of lenders and all that stuff. We're just really talking about rates today. And I just wanted you to get an idea that you can probably see rates in the 5 to 8% range, give or take. And then you have owner occupied, which we mentioned before, which would be typically we're going to go to the SBA for these types of loans. This would be something like a restaurant or somewhere where somebody owns a business and they want to buy the real estate where they want to put that business. So most common for that is the SBA 7A loan product. And those rates, unfortunately, right now are over 10% in most cases, or I think in all cases actually. So the 7A, because of the benchmark that they use to get that rate, which we're going to talk about in just a second, is a pretty high rate loan in today's environment. But that loan itself comes with so many advantages that most people are willing to still pay those rates, it appears. And we're doing a fair amount of 7As currently. There's also something known as the SBA 504. Those have not experienced, because again, they come from a different index, they come from a different benchmark. Those rates are still in the 6 to 8% range as it goes. And then, as I mentioned, you have something called specialty, and specialty is really anything that doesn't fit in the categories that we already discussed. And on those, rates are all over the map. It just really depends on what you're doing. It could be something in the cannabis world, or there's just all sorts of different sort of specialty. You can call them non-bankable, what have you. But there are lenders out there that actually specialize in these categories that other lenders won't even touch. So it's tough to give any kind of a rate explanation there, but they are out there, and just know that they're out there. So tough for me to talk about rates in the specialty realm, but there are lenders out there that will look at these. Okay, and at this point in the video, I just wanted to put in a reminder. These factors will always play a part in the rate. I said it before, I'm going to say it again. Asset type, amount of down payment, experience, net worth, liquidity, loan amount, repayment terms, prepayment penalty, full recourse versus non-recourse, buy down, location by population, lender appetite, debt coverage ratio, index used, which lender you've selected, and which program within that lender you select. All of these things go into the big shaker box to figure out ultimately what your interest rate is going to be. So, and there's more than that, by the way. There's a lot of factors that go into these rates. Just a quick reminder as we go through this. I get this question a lot too. I just wanted to throw this in here before we go into the different indexes. People ask, doesn't the Fed control the interest rates? You hear about the Fed, the Federal Reserve. They have these meetings and they sit in there and they do what they do. They look at all the reports, and then they come out and they give a big speech, and they talk about what they're going to do with the what's called the Fed funds rate. And that Fed funds rate is something that is watched very, very carefully by people in the lending world and the financial community and things like that. But the Fed funds rate is its own rate, and people get this confused, I think. So I have even sophisticated investors that I work with that are following the Fed meeting, thinking that their interest rate may go up or down based on what the Fed says. And while it is indirectly tied, what the Fed does is not directly tied to anything really except for prime rate. And prime is also an index, which we're going to talk about, I think, in the next slide here. So the Fed, I just wanted to make the point here that when you hear about the Fed meetings and the Feds are going to drop rates, or they're going to increase rates, or they're going to hold steady, whatever it is an indication of where things are headed, but it's not a direct line to exactly where that rate, your interest rate that you're working on, may or may not. Your interest rate might go the opposite direction of what the Fed does in the short term. So where they are tied, though, is, as you see here, this little explanation is that the Fed rate is, the prime rate is typically 3% higher than the Fed funds rate. So that is something that is fairly close. I think it's almost always the same. It's almost always 3% higher than where the Fed is. And the Fed funds rate is currently at 5.25 to 5.5. So when you hear about the Fed funds rate, the federal meeting, when they're cutting their rate or they're increasing their rate, that's the rate they're increasing. They're not actually increasing the prime rate, but the prime rate is set by banks, and that prime rate will go up typically if the Fed raised, or if the Fed lowered, the prime rate should lower in accordance with that same position. All right, just wanted to make that clear. That's a question I get a lot, actually, and I think it's an important one to understand as you go through and start to really understand how these rates are derived. So as I just mentioned, most rates are determined by an index or a benchmark, and then what happens is whatever that index and benchmark that particular lender is using or that particular loan program is using to calculate the interest rate, the lender will typically add a margin or a yield spread, an amount of a percentage essentially to that index. So you've got common indices, which are I think there's only 3 that we have listed here. Yeah, so there's 3 that are very common. SOFR, which stands for the Secured Overnight Financing Rate. We're not going to get into exactly how they come up with the SOFR overnight financing rate. Just to understand that it does change every single day. And it's something you can look up. You can just Google up SOFR, what is SOFR today? And then you have to understand which SOFR you're going to look at, because they have a 1 month, they have a 1 year, they have these different time frames for this index. And if you're getting a loan, you should ask your lender, if they're tying to the SOFR, you need to understand, which index are they using to create your loan. Most lenders will share this information with you, by the way. And we work mostly with treasury indexes for the stuff that we do here, and prime to a degree because we work with the SBA a lot. SOFR is something found more in commercial. A lot of different commercial loans will bench off the SOFR. So just understand those are, just so you know those terms, that's what you're going to hear. Those are the 3 indices that we typically see when calculating rates. So here's a quick example. You're doing a loan, and this example was really almost a real world example of an agency loan for a multifamily building. This is something we see a lot of, and we do a lot of loans that are 10-year term, 30-year amort loans. That's very common, very typical in multifamily. You've got the 10-year Treasury index. When we last looked, it was 4.15%. That's the index that it shows. And that's historically, or let's say over the last few years, that has gone up. It was going up a little higher than that in the fall, and it has come back down a little bit. We like to see that obviously below 4 and then below 3. And then you've got your yield, your lender yield, which, remember, this is going to be determined by the risk factors involved in the loan. So there's no way for somebody like me to say, hey, the lender yield of today, let's say, is 2.5%. It's impossible to do. It's calculated based on risk and all sorts of different factors. They come back and they say, okay, here's the risk assessment. Here's what we're going to add on top of the index. They do that, and they add the 4.15%. And this would be, by the way, at the time that you lock your rate. So even sometimes you'll get a quote. You'll think your rate is 6.65 based on this example, but that 10-year index maybe it drops, by 0.15% over the next 30 days while you're in underwriting, and then you're getting ready to close, and then you're going to lock your loan, and so now your rate goes down to 6.5%, right? So it could drop or it could go up. It depends on where that index is the day of the lock. Really important to know. So even while we can quote somebody, sometimes we'll get all the way to where we know what the lender yield is going to be. We know the index, but sometimes we can't lock that rate until we're almost done. And we're at the mercy of the market, truly, for the final interest rate. That's how tricky it is to get into actually giving somebody a real interest rate. It floats all the way down to the end in many cases. Fortunately, there are lenders and loan programs that you can lock up front. Some of them just come in with a rate card, and this is their rate until they change it. Sometimes they have fixed rates on their rate cards. So again, it's kind of all over the map as far as when you can lock your rate in and when you can actually know your interest rate. Okay, so let's have a little fun here. Is a lower interest rate always better? Well, let's find out. First of all, what is your goal as an investor? And I think if you're like most investors, if you're going to hold on to a property, your goal is very likely going to be cash flow. To me, that's kind of the name of the game. That's what most people are investing for. Obviously, you have your fix and flippers. You have people that are looking to just increase equity each time, which is fine. But when we're talking about interest rates, where it really matters is in the longer term loan, right? So we wanted to do this exercise to see, is the interest rate always better? Well, here we go. So I got 3 scenarios for you. And right now they're all the same. We have a $1 million loan with a 5% interest rate. We have a $1 million loan with a 6% interest rate. And we have a $1 million loan with a 7% interest rate. So here's the quiz. Which one is better? And just remember, I haven't given you all the information. All right, got it figured out yet? Okay, so here we go. Scenario number 1 is 5%, but it has a 20-year amortization. So 5% 20-year amort. Scenario 2 has a 6% and a 30-year amort. And scenario number 3 is a 7% interest rate, but you only have to pay interest-only payments. So which one's best, right? Here we go. Scenario number 1, at 5% with a 20-year am on a $1 million loan, your monthly payment is $6,600. Not bad, right? Scenario number 2, with 6% and 30-year amort, your payment is, look at that, it drops more than $600 a month, but your interest rate went up a full percent. That's how much the amortization can change the payment. And then scenario number 3, it's 7%, but it's interest only, and your payment is the lowest of the 3 here, $58.33. So if your goal, and that's what I go back to, if your goal is cash flow, there are other things to consider beside the interest rate. That's kind of the big lesson here. So while the interest rate certainly is important and it's a factor, it's always a factor, there are so many other things that you want to focus on just beside looking at the interest rate. I'm telling you, it goes on and on and on and on. So this was just a little fun example I was trying to kind of show that you really don't, you can do better cash flow if you change some other factors, even with a higher interest rate. If I should have probably run this out at 5% all the way across and shown what that payment would be as a, let's say, as a 5% interest only, where they would be equal. But even so, here we're up 2%, and we still have the lowest payment just because we were able to get interest only payments. And again, if you're looking on a time horizon of a 3 to 5 year hold, or even a 7-year hold of an asset, you're not going to really do a whole lot of damage in principal, paying down principal over that time anyway. So you might as well go for interest only if it's available. Most investors, when that's available, that I work with, will take that option all day long, as you see what it does to your payment and ultimately to your cash flow on the asset. All right, so here we go. My prediction for 2024. I thought about this a lot, but here's where I come in. I believe that based on the data, based on what we can see right now, and this is pretty much based on what the Fed has in their own documents, they are looking to hold, and ultimately I believe they're going to start cutting their rates this year. And remember, their rates don't necessarily mean interest rates, mortgage interest rates, or what have you. It means that they're looking to cut back on the Fed funds rate, which will take down the prime rate at least. Okay, they're looking to kind of switch from where they have been, which was monetary tightening, to moving to more of an easing phase, which will make credit loosen up, or it should. It should increase liquidity into the market, and ultimately, I believe this means lower interest rates across the spectrum. So that's my prediction. I'm not Nostradamus, but let's see what happens. And this is based on a lot of conversations with lots of people in the industry, just my own research and things like that. But I think it's a pretty safe bet, and I think we're looking for a great year, certainly here, and hopefully you are as well. And I hope this little bit of information does help you. All right, and we're at the end here, and so let's talk about the pro tip. I think it's only one tip actually in this case, but as you can see, this stuff is complicated. It's really complicated. It's a simple topic. It's a simple question. What's the interest rate? But to get there it's tough. There's so many things that we have to look at. And I think personally, that's what I really like about being in this business, because it's always a puzzle. It's one loan is never the same as the one before it. So I would just tell you this. This is my biggest advice I can give. If you're somebody that wants to get into investing, or again, if you're somebody that's already investing, you really want to work with a mortgage professional that has access to multiple platforms. We've talked in other videos about going to the bank, and the bank certainly is a great place to start. Banks are having a little bit of trouble these days, and there's other issues with the banks that I see from my side. One of which is in the example we gave about what is better, from an interest rate perspective. Banks will typically issue loans with shorter AM schedules. And that's one way we win a lot of deals from banks, because we're able to offer longer amortization or interest only options to our clients, because we look across the spectrum. We're always talking to lenders. That's where I spend most of my time here at Capital Connection, frankly, is I'm on the phone with lenders, morning to night, and discussing what are they doing, what program, where are their appetites, do they have any money on sale, let's say. Sometimes they're really looking to deploy capital, and they'll discount that capital in the form of interest rate discounts. So there are so many different factors, again, that go into it. There's no way one individual or one investor can stay up with it. I give the story sometimes of a client that I used to work with, that we did probably 12 or 13 loans for them. They were all multifamily. It was the same borrower each time. And we went to, I think, 8 or 9 different lenders and different loan programs across the time that we worked together, because that's what was needed for that specific deal. So again, when it comes to rates and programs, you really should work with somebody. We would obviously like it to be us, but it doesn't have to be us. But find somebody that specializes and has access to multiple different platforms. This is not a one-size-fits-all business. It never has been. You may be somebody that invests in 1 to 4 unit properties, and that's all you do, and you're just fixing and flipping in Gatlinburg, Tennessee, and that's your thing, and that's awesome. But you may, and maybe you go to your rich uncle, I don't know, you go somewhere for money. That money may run out. You might be able to get it more leverage somewhere else. There's so many different factors, again, that go into it, from deal to deal to deal, even if you're relatively in the same bucket or asset class or whatever. So that's my tip. Reach out to us if you've got any questions. And by the way, if you'd like me to do more videos on rates in specific, we get a lot of questions about rates, and I felt like it was time to kind of just clear the air a little bit and talk about, wait a minute, we love to give you a rate, but we really have to get to know you, and we have to get to know what you're looking to do before we can really get down and dirty on what rate we're talking about. So I would like to do some more videos and some more trainings on what specific products are doing and things like that. And I'd love to hear from you. If you want to see more of this, if it's helping you, please subscribe to the channel. Please send us some likes. We're in our infancy stage. We're trying to build this thing, and I really want to hear from you. Had some great success out of the gate here. Lots of subscribers coming on board, and I think this thing's going to go, but really want to hear from you, and I appreciate it. With that, I'll say I'll see you on the next video.